Good evening, and welcome to another session with Coach Ray, the market trader. Today, we're going to be talking about a concept that's often misunderstood among traders, and that's the difference between initial balance and opening range. But before we can dive into the discussion, let's begin by reviewing our risk disclosure. Okay, so we all understand that the content that's being published here by the market trader and its affiliates is to be treated as general information. None of the information provided by the market trader is intended as investment advice, an offer to buy, sell, recommend, endorse, or sponsor any security, company, instrument, or fund. We all understand that future trading does carry a fair amount of risk and is not for every investor. An investor could potentially lose all or more than their initial investment capital. So only risk capital, money that may be lost without jeopardizing one's financial security or lifestyle, should be used for trading. And only those with sufficient risk capital should consider trading. Nothing contained, again, herein is a solicitation to offer, buy, sell futures, options, or stock. Past performance is not necessarily indicative of future results. So, what is initial balance and opening range? Well, before we can talk about initial balance, we need to understand what the initial balance definition is. Now, the definition of initial balance is the price range that's established during the first hour of the trading session. So if we're talking equities, we're talking 9:30 to 10:30 Eastern Standard Time. If we're talking crude oil, we're looking at 9 a.m. to 10 a.m. Eastern Standard Time as the range in which we identify the high and low price of the first hour. And then gold, we would be looking at 8:30 to 9:30 Eastern Time as the window in which we would identify the high and the low of the first hour. Okay. Now, this range is used to determine key levels of support and resistance for the session. It provides traders with valuable insights on the market sentiment, potential volatility in the market, and key levels for potential trading opportunities. Opening range, on the other hand, is a component of initial balance. It represents the price range of an instrument for a specific period. 1 minute candle, 15-minute candle, 5-minute candle. We take the low and the high, sometimes between regular trading sessions, regular trading hours, potentially taking the high or low of a prior session with the low or high of the opening session. That's one method. But the idea, it's period based. It is far less than a 60-minute. We're trying to gauge what the general sentiment of the market is.